Good morning, everyone. This is Sylvia Herzog from the Charcoal Project. Today, we are happy to be here to talk about predicting cash flow. This presentation is part of our HFI Kenya program, Quick Skills Review, which we're starting this month and we'll be doing monthly from here on for the rest of the program. So, given everyone's recent issues with COVID, we thought it was important to start to really focus on cash flow and hoping that this will help people get a little better at predicting what their cash flow needs are and what they can do to impact those. I'm going to just shut my video off here, and you guys should be able to see the screen. And we're going to go through these slides, like I said, fairly quickly, and then we'll have a Q&A at the end. Whoops, went too fast. Okay, so why do we need to predict cash flow? You guys all know this because you can be in severe cash straits very quickly without really understanding why, even if your business is profitable and your sales are booming. So it's really important to be able to forecast and predict what your cash flow needs are for the business so you can anticipate when and where you'll need cash, and keeping in mind that this is the #1 killer of all businesses is people basically growing themselves out of cash. And I know you've all experienced this, talked to some of you separately about it, and that's why I just really want to emphasize the importance of you really getting a good handle on this. We're not going to talk today about funding, like, okay, so I figured out how much cash I need, so where am I going to get it? That will be the topic of another quick skills review. But for today, you really have to take it step by step, and the first thing to do is really try to figure out how to measure it and how to predict when and where I'm going to need it. So we're going to talk about cash flow drivers today. Then we're going to talk about projecting your cash flow needs, and then troubleshooting during a tight situation like now, COVID. So the first thing we want to talk about when we talk about cash flow drivers is working capital. Sorry if that keeps flipping back. It's the one thing that people don't have a good handle on, especially small business owners. Quite often, you do your budgets, you plan for all your capital expenditures, you plan for salaries, you plan for marketing expenses, but you don't really take into account the fact that you need to build things before you can sell them. And so therefore, financing is needed in advance of sales. So there's big timing issues. So working capital is something that outside financiers look at a lot because they want to know, well, how liquid is this company? If I lend to them, can they really repay me? So they use it as a measure of liquidity, and the way you measure that is current assets less current liabilities. So do I have enough in inventory and receivables to sell off or recover to repay my current liabilities, which might be my credit card bills or my short-term loans? Longer term lenders aren't usually looking at working capital for repayment. They're looking at maybe they have a lien on your equipment or something like that, or a mortgage. So longer term lenders are looking at a different thing than a short-term lender. So working capital also isn't just used in that static sense of how do my assets compare to my liabilities. It's also used more broadly to describe how current assets and liabilities affect the cash flow of the company. So you often hear people talking about a working capital line of credit. That's something that helps you fund your balance sheet. It helps you fund that mismatch between when I have to build and when I have to sell. So it's more broadly used, and it's affecting how it's addressing the fact that if I increase my assets, if I increase my inventory, I've used cash for it. If I've granted credit to my customers, that's essentially using cash for it. I have foregone collection of cash, at least for that month. The same on liabilities. If I increase my liabilities, I'm generating cash. That means I drew down on a credit card, that gave me cash. Or I didn't pay my electric bill that month, that basically gave me cash. So you basically want to look at these different things, pay a lot of attention to them because they can have a big impact on your cash position of the firm and how you manage things day to day. So let's see, whoops, too fast. That was working capital. So we're going to talk about cash inflows and cash outflows. And again, I'm going through this quickly because I know a lot of you have been exposed to it, but I want to review it and then make sure you understand it. And again, if you have a question, either hand raise or put it in the chat box, but no, we'll have time for Q&A at the end. So cash inflow, what affects cash inflowing to the cash flowing into your company? Well, obviously operations. So I get sales and I have expenses and the net income is my cash flow in. That's very self-explanatory. Then I have this working capital thing we're talking about. What would cause, what part of working capital would cause me to increase my cash flow? As I mentioned before, increasing payables, say drawing down on a short-term loan, or reducing inventory. So I have my inventory, I have 150 bags and I decide to sell them all. Then I get all that cash in from, I've converted my inventory into cash. And decreasing receivables. Maybe I decide I'm not giving anyone terms anymore. I can't work it out with the funding. I need the money up front. So I decrease my receivables. Those things cause cash inflows. And then obviously outside financing. I can raise equity, I can borrow debt, or I can apply for grants and possibly get a grant funding. And those are all cash inflows. Well, what's cash outflows? What drives cash out of the business? Again, from operations, maybe we're not making any money. Revenue minus expenses is a net loss. So now I'm losing money, I'm losing cash on all my transactions. Again, working capital, but the other side of it, what working capital impacts are negative on cash flow? Decreasing payables. If I turn around and pay off my credit card, I've used cash to do that. If I want to build inventory, so if I say, oh, I can't take not having inventory when my customers ask me for it. I want to have an extra 1 ton in inventory every month. So I build that so that then that causes me to lose cash because I just took my cash and put it into inventory. And again, increasing receivables. So maybe my bigger clients want 30 days net or 60 days net. And they won't have it any other way. So if I want that client, then I'm going to have a receivable on the books from them, which means they're going to delay paying me, and that's going to use up cash. And then finally, outside financing. Again, while generally you think of it as coming in, you have to eventually repay that debt, and sometimes you have to issue dividends to equity holders. You don't generally have to repay grants, but then those are actually a lot rarer anyway. So if we get them, we can. If we don't, we have to, like most businesses, rely on debt or equity. So just make sure here. Okay. So what are some of the key issues? Really the biggest issue is that, all of you are in growing businesses, and the problem is for a growing business is you're in a cash squeeze, and it's for a number of reasons. First is product costs have to be incurred before sales are made. So the faster you grow, the worse this problem gets. If I have a big upward trend in sales, then I'm putting a lot of money into inventory and probably receivables as well. And there's a delay before I get that cash in for the sales. So that really puts a crimp on cash and really causes a big squeeze. You may not be operating profitably. You may not be a startup, but you may have been in business a year or two and you're still not profitable because you haven't yet got to the scale you need to get to. Or, it's COVID or something like that, some other reason why you're not operating profitably. You could also have large capital expenditures. You've bumped along at a lower scale, and now you want to really increase, and so you're looking at buying all new equipment or moving to a bigger property or building a drying shed, all these different things cause you to have large capital expenditures. And then the small and early stage businesses have a hard time attracting capital. So maybe you really were bootstrapping this to begin with and never really had a big investor coming in to help you out. And then the final thing is small businesses rarely plan for working capital needs. So, when you're planning your business, small businesses tend to invest as much as they can and build as much capacity as they need in terms of equipment and land, and maybe even employees, but they rarely allow for the funding that is needed to fund that working capital. So if I want to sell 100 tons a month, I need to be able to support in cash the inventory it takes to sell that much, because it's not real-time processing. So all of these problems, and you may have all of these problems or only a couple of them, but each one of them can sink you basically. And if you have all of them, then you have a lot of challenges that you have to deal with. Okay, so we're going to focus on a little bit on estimating working capital needs here. So we already talked about how you're going to have hopefully some cash flow from operations, although you may not. But it's really important that you try to figure out this working capital issue, because like I said, most of you have not focused on it in the past, and it's really something that is important and you have to really focus on. So optimally, you would build a financial model that would forecast cash flow, and that would tell you how much cash flow you need in any given month. And from there, you would figure out how to get it. So, if you have a model, if you're good enough to have developed your profit and loss statement on a monthly basis, and then you can also develop a balance sheet on a monthly basis, then from there you determine cash flow. It's an easy calculation from those two things. And this is if you can do this, this is fantastic. This is something that a lender or a funder would expect to see and will make them feel comfortable that you know what you're talking about and you understand your numbers. It's not necessarily a negative thing to show negative cash flow, because for an investor, they're looking for growth models. And if you have negative cash flow, it's probably because you're growing. So the point is to show them that you need the cash, and that they coming in with capital can help you manage the situation so that you can continue to grow. So I am going to share with you two different financial models. But I understand that not everyone is great on Excel or doesn't have the capacity to really spend a lot of time building out the model. So there's some other back of the envelope calculations you can do instead to try to figure out, like, just give me a ballpark. What should I really be shooting for in terms of how much working capital I need? And when I say how much working capital I need, what I'm talking about is having an amount in the bank at the beginning of the month so that you can go through your operations, and during that month those funds would be drawn down, but then they'll be replenished with sales, with cash coming in from sales. So there'll still be an up and down in your cash, but you're starting with an amount that will allow you to operate during the month and then retrieve the cash flow from sales that will replenish the bank account. So we're hoping for, on average, kind of a minimum amount in your bank account. So the back of the envelope calculation is basically, you want to figure out what inventory you feel like you need to hold times your unit cost. So most of you have figured out what your unit costs are. So you can, if you think about that times your inventory, you don't have to value it at the retail price. You just have to value it at your cost. And then you're going to also add in a percent of sales that you use receivables for. So maybe 10% of your clients you give credit to. So that's the amount you're basically financing them. And then you're going to add in something for payables due each month. So maybe you have a credit card you're paying off every month that you need to take account for. And then you're going to add in your profit and loss from the prior month. And that's kind of your back of the envelope calculation for how much cash you need / have. I'm going to go through a quick example here. I hope it's clarified. I did this kind of quick and dirty, so hopefully there will be relatively few issues with the numbers, but we'll go through and take a look. So Betty has a briquette. Excuse me, I'll take a little sip of water here. Betty has a briquette business. She sells 150 bags of briquettes a month, but feels like she needs to have 80 bags available at any time, you know, to service her clients. She gives her larger customers, which is 10% of a volume, 30-day grace period. Her unit cost is 15 shillings per kg. She usually has payables about 10,000 kg or 10,000 shillings per month. So we're going to go through like a little exercise. How much would she need to have at the beginning of the month so that she can get through the month, basically? And so we're going to value what her that optimal inventory would be, which if you look at the calculation here, her unit cost times 50 kg per bag times 80 bags. So she needs 60,000 shillings for inventory. Then her receivables, again, if she sells 150 bags at 50 kg and 10% of that times the unit cost is, oh, actually, I probably shouldn't have used the unit cost. I should have used the sale price there, but that's okay. We can go back and revisit that. So that will be even a little higher. So you get the idea, though. We're going to estimate 10% of her receivable value is money that she's not getting in, so needs to finance. And then payables. You know, we'll just assume that she has 10,000 payables. 10,000 shillings in payables that she has to worry about every month. So that's basically her kind of basic working capital need for the month. Oops, wrong thing. Okay, so we did her working capital, but then you still have to add in the other determinants of cash flow, which is whether or not she has cash from operations and any outside financing. So to continue with our example, Betty operates just below break even. So she's losing, 1,000 shillings a month. So she's close, but she's not quite there. And she's been funding her losses with loans from a community lending circle. The other thing to think of is one other thing. I mean, we've kind of calculated what inventory we had, and we've said what our losses are, and we've said what our financing opportunities are. But then, I kind of always like a cushion, okay? Because at the end of the day, even if, I'm still going to have some timing differences between my sales of 150 bags and when it, even if I'm getting cash in from last month and cash going out next month, or maybe the truck breaks down or something like that. So you just basically know you need a cushion. And I would just, over time, you kind of should know what your cushion should be, but you can start with like a 10% cash cushion just to have that in the bank, so that the truck needing a new battery doesn't put you out of business because you don't have any cash to fix it. So here I'm just adding up those different monthly needs for Betty's briquette business. She needed the working capital. She has a loss. She has a timing cushion, which was just 10% of sales. And then she has some financing she gets from a lending circle. So you end up with what her cash needs are. I'm just going to pause there for a second. I just covered a lot. Does anybody have a question, or if I don't see anyone's a question, I'll just keep going.
Sylvia, I don't know whether I missed something.
Sure.
Did I hear you say you have a template?
Yes, I'm going to get to that. I just wanted
okay.
to share the concept now to see, do you guys understand, these are things that you have to, figure out. You can kind of do it back of the envelope, but we also have, templates. I have like an easy version, which I'm going to share now. And then I have a more, a more complete version, if you will. So, you can look at them both and see what best suits your needs. But this is just, to cover, the ideas of what you have to account for. Does anybody have any other questions? Does that help you, Dorothy? Okay.
Yes, I am happy you have 2 templates that you can share with us. I think it will make it easier.
Yes, it will make it easier. So
yeah, and of course you're going to share the presentation, so
yes,
that will even make it a fast way of learning.
Okay. No. Okay. Good. Okay. All right. So let's see. I'm going to move on now. Okay, we did this already. Okay. So now we're getting to the financial modeling. Okay, so I have 2 models. One that I've used a lot with entrepreneurs, and it's basically a, I'll show it to you really quickly. Let's see, let's change my screen sharing. One sec. Okay, so I shifted to the screen share, and I seem to have lost everyone. Okay. There we go. Okay. Sorry, I shifted to the screen share, and now I'm just showing you. This is the bigger version. Okay, so this is the template that that you can predict. And I may have shared it with some of you. I feel like I've given it to Beatrice. Maybe it's a monthly template where you can you start with your revenues, and from that you input your costs and your balance sheet, and then from there it calculates your cash flow for you. So you get this nice cash flow statement, which is what I was kind of referring to before, where I'm predicting my cash flow from operations, and then I'm showing calculating all my changes in working capital. The model does it for you. And then I'm adding in my changes in external financing, and then I get a kind of a net cash flow. And this is the way I can monitor my my cash balance on a day-to-day basis. And this is great if you can do it. And it's just an Excel model, so you obviously can modify all the expense calculations and the expense line items, and name your products, and it also gives you a summary, full year summary that you can use to print out, so you can get a full thing, and there's instructions. So I've used this template for years. But if you're really not comfortable at all with Excel, it probably, or you're not super comfortable with your financials, it may be a little too much for you. But I will share this with anyone who wants to use it. I'll make it available to everyone. It's a great tool to use, and you can certainly customize it. Um, but it is a little more complex than the next one I'm going to talk about. So I am going to stop share again and then switch to the other screen. So hang on one second. Okay, so now this is, hopefully everybody can see that. This is a more simplified cash flow statement. It just, as we just did in the presentation, it just focuses on inflows and outflows, and then shows you a net cash balance. I've continued with Betty's briquette business, and you can see she's in fairly dire need of cash pretty soon after we get started here. And this, just for example purposes, in the initial run here, I have no change in sales, so she's not growing at all, and she still quickly needs cash, and that's because she's not operating profitably. And then also she has some other things. So let me just quickly go through the what these different tabs are, and then I will go back and explain kind of how things are working for Betty's business here, and why she's showing such negative cash. So the first page, the first tab is cash inflows, and again, you're just going to go cash receipts, and this is cash from sales. So this is not total sales, because if you are getting things on, if you're giving terms to people, then you just want to show what you're collecting that month. So maybe, again, in this case, Betty was giving 10% on account. So each month she only receives 90% of her sales, but then she receives 10% from last month. So you can see how I've laid that out here. Again, just kind of using simple numbers, but that's how you have to think about it. I'm going to get some portion of my sales this month, but then next month I'll get whatever I had on credit from last month. And then this was, I think I mentioned she had like a community circle that she was taking money from every month. So, that's another place for her to get cash. And then this is just going to total what your inputs are, and then add it to this starting balance here, that everybody has some starting balance. She doesn't have a lot. She's got 50,000 in the bank. So she starts with something. And, obviously your ongoing businesses, you have to kind of pick a starting point. I just picked, December 31st, because it's just easier, but you can change the months. You could start in October, just change all these monthly numbers, this is pretty automated. So anything I change in the heading here will, go to the other two tabs as well. So it's a good little model. Excuse me. So that's cash inflows. On cash outflows, again, this is just expenses. So I put some theoretical expenses down for her briquette businesses. She's going to have supplies, she's going to have feedstock, she's going to have binder, and all of this, obviously, you can specify to what your actual business is. You have cook stoves, you're going to add those in there. Whatever it is that you need. If you have, interest payments, those go in there. These are all the things that go out of the business, all the things that run through your profit and loss statement and go out of the business. Then the final tab is things that may leave the business but aren't really part of the profit and loss statement. So these are balance sheet items. So for example, if I repay a loan, I take cash from my cash account, I put it, I give it to the bank. It doesn't really flow through the profit and loss statement. It's just a repayment of principal. It only flows through the profit and loss statement when it's an interest payment. So that you see here, these are these non-P&L outflows. If I purchase equipment, so I have a couple equipment purchases in here. So maybe she buys a new extruder. In April, again, she's taking cash. She's paying for equipment, so her equipment goes up. It's not a profit or a loss, profit and loss impact. It's only a balance sheet impact, but it does affect her cash flow because she took cash and paid for a machine, so the cash is gone. And then in August, I think I'm assuming she's buying a mixer or something. So you can see how you can, if you have capital expenditures, or you have, maybe this is where you take a draw. You're going to take a draw. It's going to go against your retained earnings. Again, it's not necessarily, it's not a P&L item. It's just owner's draw. This is where you're going to put those non-profit and loss cash flow impacts. So once you've done these outflows, you go back to the inflow statement, and you have all the cash available on line 13 here, and then you have cash outflows. These are just roll up from the other pages, and then your net cash position. Whoa, negative right away, right? Hate to see all that red, but it's there. So what happens though if I make her grow faster? It gets worse. So let's see if I can just change this so that she grows 5% a month, which doesn't seem like a lot for you to grow on 5%. Then she has an even much bigger negative cash position at the end of the year, right? And that's because she wasn't operating profitably, and also she's financing an ever growing amount of accounts receivable. And she, I think I even assumed here, yes, I did. If I look in loan, I even assumed that she got financing for that equipment in the 2 months that I showed equipment. So it's still, even with financing for equipment, her cash position is getting dire with growth. So I think this is a good, simple model to predict your cash flows on a monthly basis. It's easier than the other one. The other one is more complete, and you'll have a full P&L and a balance sheet at the end once you're done with it. But if you want to start and simplify in a simple manner, you can start with this, and you're just taking, okay, all the cash coming in, all the cash going out, and measure the difference, and that's what my cash balance will be. Does anybody have any questions about this? Or, I mean, I can share it and we can go over it another time as well, or we can just go over it individually. Does it seem fairly simple, or does it seem overly complicated? That's looking for feedback on that. Dorothy, what do you think? Is this something you would use?
Yes, I think I would use both
Okay.
of them.
Good.
Yeah, because the simplified one would be to inform on a monthly basis, or a quarterly or half year. And the first one I would be able to actually use it for a whole year, a financial year reporting, or just looking at how things have been.
Yeah, the other one actually is monthly as well. It gives you monthly cash balances, and it's pretty detailed. So I would say you probably wouldn't have to use both. You could use, if you decide you wanted to use the bigger template, that would probably be all you need to use.
For learning, I think it's just best to have both. Then you see which one you're comfortable with. Yes,
absolutely. They're a little different perspective. This is probably a little more intuitive. The simpler one is just cash in, less cash out, and the other one, it more relies on basic accounting conventions. So, you know, it's doing the actual calculation. So you do have to do a little more work in terms of forecasting your balance sheet and stuff. But again, both useful tools. And so I hope you guys will want to use them. So if there's no other immediate questions on the templates, I'm going to just move on, admitting Amadi. I'm actually going to go back to sharing the other presentation. So I'll just stop here for a sec. Okay, so we did this. We went through the two models. And now what we're going to talk a little bit about is probably what you guys are doing every day, which is troubleshooting when cash is tight. So there's a, you know, given what we just talked about given what we just talked about with working capital and all the different levers that we talked about for how working capital can affect your cash flow, you can now see these different items. You can now see how these different items can improve your cash when things are tight. Okay, so it's COVID. People have had big drop-offs in sales, or they've had restrictions on movement, or for just a variety of constraints on their cash flow. So, but even if it's not COVID, even if things are going well, we're recovering, but now we're starting to grow again, and we don't have a lot in the bank because it has been COVID. So what can we do to manage that short term? Okay, so from a balance sheet perspective, and these are all things that are, not all of them, but you know, the first few things are all things that are affecting working capital. Yeah, the first thing we want to, the first thing we probably will do is stretch our payables. There's two schools of thought on that. One is obviously just don't pay people as fast as you normally would, because you know, it's a sense of, it's, you know, kind of forcing them to finance you. Other people might argue that you would pay your suppliers right away, because you may be able to negotiate better terms if you're able to pay them right away. You know, that's just a question of, you know, how severe is your position. If you have some flexibility and you can take advantage of the fact that times are tough now for everyone, look, I'll pay you right away, but maybe you'll give me a discount, then that would be fantastic, because long-term that's good for your cash flow and profitability. But more likely, you'll probably just have to pay everything in the last possible date so that you avoid fees, but so that you have use of that cash as long as possible. You can shrink inventory. You just, you know, you may want to maintain a certain inventory, but you may not have a choice. You may just have to get rid of that inventory so I can pay my workers. And you just shrink your inventory by selling it. You could sell it at a, you know, basically a fire sale if you have to, just to get cash in. Sometimes you have to pay the rent. So, you know, none of these are all kind of short-term reactions, but you know, the things you have to do. If you have to do, you may not want to do them, but think of them as something short-term. If you find you're having to do these every month, then you have to take a step back and say, okay, I need some longer-term strategies to get me out of this hole that I'm in. Another thing short-term you can do is shrink your receivables. Improve your collection, make some phone calls, keep hounding people until they pay you at least something. Allow them to pay you something if they don't have it all. All of that will help. Also, just shorten your terms. If you normally gave them 30 days, now give them 15 days. Or charge for it. You can either charge explicitly for financing, say, you know, if I give you 30 days, you have to pay more, or you just give a discount for upfront payment, which probably is more palatable to most people. You could also require deposits on large orders. That's another way to get, if you require 10 or 15 or even 50% deposit on a big order, then that will go a long way to financing the working capital you need for that order. Sell unused assets. I have to say, when I visit you guys, I walk around, I see a lot of old equipment that you don't use anymore. Sell it, scrap it, do whatever you can, get cash out of it. You're not going to use it again. You've moved on from there. Just get rid of it and get the cash out of it so that you can do some good with it. Obviously, if you can, you want to borrow, raise equity, and apply for grants. The issue with grants is how long they take. It takes so long, and then it's very competitive, and there's no guarantees. Right now, there's a number of COVID opportunities that I've seen here and there. We try to share them when we see them. Apply for them if you can, because grant money is free money, and you don't have to repay it. So that's a very good thing. The other thing regarding borrowing, you could lend, you could sell your personal assets and lend it to the company if you're in a real bind. Maybe you're not in a position to make a further equity investment, but maybe you could sell something and lend the money to the company. Or maybe you have friends and family who can lend something to the company. For the most part right now, interest rates are so low everywhere on savings that friends and family may be very interested in earning some interest, that they wouldn't be able to get at a bank. So you may be able to get people to send you, give you small amounts, lend you small amounts, enough to get you through these tight times. And also there are a lot of lending circles that you could join or be part of, community lending circles. Again, and they seem like small amounts, but sometimes small amounts can get you over the hump, and so that you can be ready for the next day. So don't disdain at raising smaller amounts, because they can really be helpful in a pinch. And finally, if you're really in a cash crunch, you're going to have to delay investments and possibly your capital expenditures, which obviously you don't want to do for long-term growth, but you can only do what you can do. And if cash is tight and you need to keep your employees, you'll need to pay them before, upgrading your mixer or something like that. All right. Beyond the balance sheet, there's also ways to raise cash from your, that are related to sales and expenses. You can always raise prices, and maybe you can't explicitly raise prices, but you can say charge for delivery or charge for financing. That's one way to get a little more money, or bump it up a little bit, get a little more money out of what you're, that could be why you're having cash flow problems to begin with, is that you're not charging enough money. And so you're not being profitable and you need to charge more. So that's always an option. I know most people will say, oh, I can't possibly charge more, but you have to play with it. You have to consider it. You have to analyze it and see if there's ways that you can add fees or something if you can't, if you have a hard stop on the price of the good. On the other hand, you could raise prices. You can also reduce prices just to liquidate your inventory, like I was saying before. You just need cash in the door. So you reduce prices and you have a fire sale, basically. It doesn't have to be that dramatic, but offer some quantity discounts, offer some sale prices, get rid of your inventory. It just frees up some cash so that you can do with it what you need. You want to look at cost reduction. You want to relook at your operating efficiency. I know all of you guys are doing this right now, but this is just a reminder, these are important things to be doing on a continual basis. You could shift salespeople to commission. I know some of you have done that. It just takes off some regular cash sales and ties their compensation to performance. You could always do it temporarily. I mean, if you don't believe long run that's the best way to keep people, then just make it short term until everybody's back on their feet. And I think right now, times are tough. People understand that compromises have to be made on all sides, on management and on labor. You could try sharing service with other companies. Some of the people in this group are doing that now. You guys are reaching out to each other to providing bulk sales. You could try to buy services in bulk. For example, even like Dan and I were talking about possibly getting a group rate for testing with Curdy. Things like that, where you think you could get a group sale, group discount. Talk to other people in this group, talk to your BPA members, see if people want to partner up. Maybe if you all use the same binder and you're all in, the coastal part of Kenya, you could, team up and buy a big delivery of binder, and then parse it out at a lower cost. So everything's up, I guess, for relooking at and rethinking and partnering, even if you're not physically right next to each other. Try to think outside of the box as to what kind of services you could possibly team up with other people on to get some kind of price break. All right, well, that's pretty much everything I had to talk about today, but so I wanted to open it up now for questions. Does anybody have any questions, either about the modeling, either about managing their cash flow in general, issues you want to chat about, things you don't think I covered? Open mic time. Anybody want to talk? Brian, I know you and I have talked about cash flow issues a little bit. Anything you want to share?
Hi, Sylvia.
Hey, Dorothy.
Okay. Yes. I just want to talk about the current situation that we are facing, and hear maybe your advice on this. Our cash receivables and payables. I hope I'm using the right terms. That is the credit that you could possibly get, and of course collecting your sales from your customers. That is what I want to talk about. So I don't know whether I'm using the right terms. Yes, when I say
you are.
Okay.
You are. Yeah, go ahead.
Okay. So what is happening currently? Customers are not able to pay for the products as before. And if they buy, then they're really using the briquettes very sparingly. They would rather buy the normal charcoal and mix with the briquettes, and like just using the briquettes alone. So this is really affecting sales. And on the other side, you find that if you had credit supply, then that means that for any raw material, your supplier is not willing to supply you more. So this is really bringing a lot of constraint in cash flow. And I just don't know whether you have any ideas on how.
So basically your sales reduction in sales have reduced your cash flow, right?
Yes.
And your suppliers are also feeling the pinch, so they're not willing to extend any credit either.
Yes.
Are you up to date with your suppliers, or they won't extend further credit? Okay.
Not yet.
So they wouldn't. If you paid them, they would come back.
Yes.
Right.
Yes.
So in this situation, I think because it is so dire, you know, the key is you need to get your sales moving again. How is your inventory? Do you have any left?
Yeah, we still have some
You said that's
briquettes.
good. That's good because you have something to sell, so that's good. So I think that I would, if I were you, I would follow 2 tracks. One is I would reach out to some of the nonprofit microfinance groups. Not I mean, microfinance funny has gotten a strange reputation, I think, there, because you have people who call themselves microfinance, but they're really just like shark lenders. So,
Mm-hmm.
so you really want one of the nonprofit groups who's really in it to finance, and see if there's ways you can partner for the cook stoves, because I know you sell cook stoves, and they're probably more
Yes.
willing to partner on the cook stoves than on the briquettes. And that way you can maybe jigger in some, you know, if you're able to offer financing on the cook stoves, that may jumpstart some of your sales there, which would help your cash flow and help your you being able to repay your suppliers. So I think the checking out the microfinance organizations, again, the nonprofit ones, is a good idea for you. We're also going to talk about down the road some crowdfunding opportunities. So there's some organizations like Kiva that some of you, if you're pretty okay on social media, may be able to raise some emergency cash from. And that's another opportunity if, I mean, if all else fails, like basically, you know, your customers are getting hammered here by the economy. So it's going to affect you. There's not that much you can do in terms of jump starting their income. All you can do is discount what you have to make it more affordable to them and find ways to finance them, and apply for grants. But you're a little bit in the situation where you have to wait for some rebound. The other thing you can do is try to pivot to different type of sales. So, you know, I know you're in a more rural area. Maybe if the urban area is not that far, and maybe you can partner with someone who distributes in Nairobi and get your product to them. So that, I mean, they're still buying charcoal, they're still buying briquettes. They have no choice. They can't go out and pick wood. So maybe a partnership so that you can pivot to a more urban setting would be helpful to you, is to try to get those sales going. But for you, it's all about, it's not even so much cash flow, it's getting sales in, because everything is fallen off, right?
Thank you.
Is that helpful? I think,
Yeah.
I think between the microfinance and possibly partnering with one of the distributors in Nairobi, I think that could be a good way to jumpstart things.
Thank you.
And we can talk more about it, Dorothy.
Okay, fine.
Okay, Brian has asked a question. Everyone open environment. My question is, we're currently experiencing poor pay model by clients, thus affect their sales. We opt to invoice discounting from our financiers, but should we add interest cap to the end customers? Or, yeah, so that's, you know, that's something I've always felt is important for you to be explicit about with your customers. So if you're granting them terms, you are financing them, and you have to pay for that financing one way or the other. Either you're actually paying interest on loans that finance you, help you finance them, or you're just struggling because you don't have the cash flow you need to get through and to grow your business. So I think that you need to be explicit about with your customers. You may not feel like you have the ability to raise prices right now, but you should show it to them as a financing cost, and you should encourage them. You could discount the upfront payment as a way to get the cash in, and show them explicitly what interest payment they are adding on. So for example, say if you're expecting them to pay you 10,000 shillings, they owe you 10,000 shillings and you've given them to the end of the month. You know, you could say, basically, you know, you're costing me 1% in financing. So if you pay me, you know, 1%, 10,000 shillings less 1% now, that will be your price. You don't have to pay me 10,000 at the end of the month. So be explicit about it and give them the choice of paying the full 10,000 or paying the lesser amount up front. The alternative is, you know, you just you say, okay, it's 10,000 now or 9,800, whatever the discount is, and I'm going to charge you more if you can't pay me right away. I like the discount up front. It just seems less confrontational. It's like you'd already agreed on a price, but I'm going to give you a break if you pay me up front, and it can help you a lot in terms of getting your cash flow going. The other thing is, you do have to be a little firm. I know you have relationships with them, but you know, there's other people you can sell this fuel to. So you know, don't let them, because they're, a lot of times I see with you guys, especially if you're dealing with poultry farmers, because they seem to be really good negotiators, you know, you get jerked around a little bit by them. And, you know, like I said, there are other customers out there, a lot of people buying charcoal, so a lot of potential opportunity for briquette producers. So, you know, be firmer in your pricing and don't just accept whatever they're willing to give, because you're just beating yourself down to an unprofitable price when you should be explicitly paying for things like, they should be explicitly paying things for like delivery and financing. So, you know, just try to stay, you know, firm but fair in your pricing, and, you know, and give them options that incent them to pay earlier. Is that helpful, Brian? Does anybody have any other questions? Okay. Okay. Well, it's great having you on today, guys. Thank you. I hope this was helpful. I will be following up. I know it was a lot of material that I went through quickly, but I will be following up with the recording and the slides, and also the 2 different versions of the model. And, you know, if you try, I would encourage you all to try either, and, you know, either model or both models, see which one works best for you. If you have, if you have any issues, I'm happy to just do a one-off call with you to walk you through things. Sometimes, particularly on the more advanced model, it just having a little overview with me will answer a lot of questions quickly and you won't be banging your head against the wall. So I don't really want you to do that. I can very quickly show you the best way to get around that model. So we can always just get on the phone on WhatsApp and share a screen and do that. Okay, so I hope you guys enjoy the rest of your day. I'll be signing up. Oh, one last thing. I just wanted to tell you about the next few quick skills reviews that we have. Oops, what happened to it? Here we go. Okay, so we finished our predicting cash flow. I don't know why that's disappearing. The next one is we're going to focus on LinkedIn. A lot of you do not have a LinkedIn page. And it's actually a really good professional tool for reaching out to people and just also to present yourself professionally online. So we're going to do a LinkedIn 101 on October 22nd. And then I have added crowdfunding to the bottom of the list. I may actually move that up if you guys think I should. But just to let you know, see, there's some of the topics that we are going to be talking about over the next few months. And if there's anything that you feel like the group would benefit from, please just text me or whatever about the topic and we'll see about adding it to the list. So anyway, great great having you guys all on today, and we'll sign off now, and have a good day. Thanks.
Thank you.
Thank you.
Thank you.
Thank you so much.